Good afternoon and welcome. Today's discussion features Peter Torrente, KPMG's US Sector Leader for Banking and Capital Markets, and our guest, Tom Michaud, President and CEO of KBW. KBW, an investment bank focused on the financial services sector, is a subsidiary of Stifel Financial. KBW's highly regarded bank research team has the broadest coverage of the banking industry on Wall Street, covering not only the nation's largest banks, but most of the leading regional banks as well. And now for our presentation.
Big welcome to all of our viewers today. We've got a great session again planned. Tom, welcome. Great to see you again. We really appreciate the outlook you give ahead of earnings, doing a little bit earlier this quarter, given 4th of July coming up next week. So really, like we usually do, love to just kick off. And what do you see as the highlights for 2Q earnings coming up in a couple of weeks?
Well, first of all, Peter, it's great to be with you, and I look forward to today's discussion. So I think the story of the second quarter earnings is very much going to be about where are we on the journey with the pivot to the post-COVID period. So I know that's a lot, but we've just gone through some incredible moments in the industry and the economy. We've just had a record pace of rate increases. We've had the impact of the COVID surge deposits. We had a record amount of deposits flow into the industry, and then they've been flowing out. So how the industry is dealing with this moment, as well as with the slowing economy, is the broader narrative. So when you dig into what the quarter is going to look like, the quarter is going to have down earnings per share again from the prior year, but the pace of decline is going to be slowing because the industry's been dealing with negative operating leverage, meaning there's been down revenues generally, led by net interest income declines, led by margin pressure from last year's comparison. But on a linked quarter basis, it's getting better. And I think we're really on an expedition to find the trough in net interest income. If I were to give what 2024 is all about, it's all about finding where that trough is in net interest income. That's important because net interest income is the biggest component of revenues for the entire industry. So we believe, and we research more American banking companies than any other firm, we believe that the preponderance of the banks are going to have troughing net interest income here in the June quarter. There are some banks that are saying our first quarter was the trough, and there are some that are going to say it'll be the third quarter. But somewhere in here in our analysis and our forecast, we expect the revenues of the industry to inflect. We can talk in a few minutes about the pace of improvement, but it's this inflection point that I think is the story. And I think that's going to be an area of focus. A lot of investors on these conference calls are going to be looking for commentary from the management teams about where is the inflection point to net interest income. And then when it comes to growth for the rest of the year, there's going to be commentary around loan growth. Now, our firm recently had a couple of investor conferences with the bank management teams. There's been a lot of channel checking going on. And I think the narrative of the second quarter is that there's been a deceleration in loan growth. And I think that's going to be part of the story. And I think if earnings estimates are changed, a smaller loan portfolio may be a good reason for why these estimates get cut after the quarter, because I think that is part of the narrative that the turn is a little slower. And that would be because we have a slowing economy. And that would be because I think banks are very cautious about how they are using their balance sheets at the moment. And then, of course, credit. Credit is probably one of the biggest headline grabbers around. We expect to see continued migration of problem credits as the industry starts to over-earn less on credit, meaning we're getting a normalization of credit. And I think you've heard me say previously, the surprise shouldn't be that credit costs are going up. The surprise is for how long it was zero, essentially. And so our models for the full year are that provisions are going to be up, let's say, 15 to 20%, yet we're still providing in the industry, or what we still see the industry providing is less than what's probably typical over the course of the cycle. And the credits that investors and observers are going to be looking for is commercial real estate, what's happening in commercial real estate, what are the banks saying? But there will absolutely be migrations towards classified, non-performing, non-accrual in the quarter. So I think analysts are going to be looking carefully at that, as well as what's happening to the consumer, especially in the subprime area in the quarter. And so I think those are going to be the big issues. We're looking for down year-over-year earnings per share. We're still looking for negative operating leverage year-over-year, but we're looking for it to be less challenging than it was in the first quarter.
Tom, maybe just a couple of follow-ups on that. When we analyzed the first quarter earnings releases, and particularly the Q&A from the analysts, maybe two other topics that come up in addition to the topics you commented on. One of them, maybe just what are you seeing around maybe deposit pricing going forward, maybe built into some of your NIM comments. And then just on expenses, I think is another area that you see a lot of questions on. Maybe just your thoughts on those two areas.
Sure. Well, first of all, the industry's been dealing with inflation just like every other industry. So there's lots of pressure on expenses. But when it comes to the net interest margin, a story that needs to really be recognized is that the 3-month, 5-year curve, which is the curve that we believe is the most applicable to banks, not the 210s that often get talked about in the media. Most banks don't invest around the 10-year treasury. It's more the 3-month, 5-year. The inversion we see right now is the length of time of that yield curve inversion is the longest it's been in over 60 years. When something is happening for the longest period of time in over 60 years, it's worth taking note. And so the fact of the matter is there's a lot of pressure on deposit costs. And I think that is going to be the driver for what happens to net interest income going forward. We think it would be a positive for the banking industry to see a Fed that begins to ease. And as that happens, it could take the heat off of deposit competition, because right now the banking industry is competing with treasuries as much as it is with other financial institutions. And of course, lower rates will help a little bit on credit. And I believe a lot of borrowers are waiting for the Fed to cut rates so they could think about borrowing again. I think there's pent-up demand to borrow because so much of the marketplace believes rates are going to be lower, not higher. So I think what happens on the interest rate front is important. Embedded in our models, our earnings models, we have one cut in 2024. We have it happening in December. We've been more cautious than the market all year. I think that's been the right call, and that's what our earnings models are predicated upon, one cut in December.
Okay. That's the quarter. Maybe looking forward as we roll into 2025, what is your maybe a little bit longer term outlook for the industry, Tom?
So I really believe that the real drivers for the industry performance is not so much what's happening exactly this quarter. I mean, if what we see is something very different than what I just said, we may have to reassess. But we're expecting here is a process in a sense, where we're looking for negative operating leverage to get a little better every quarter until we get into next year. And then we're going to see positive operating leverage, we believe. And in a year this year where maybe the median bank is going to have 3 to 4% decline in earnings per share, we think by next year, the median increase is going to be 10%. And that's because some of these headwinds are going to abate. In our opinion, and as the balance sheets get a chance to catch up with all the rapid change that we've had over the last couple of years, I think that's going to position for a better earnings profile. Now, the wild card is still credit. The biggest wild card is always credit. Our view is that we see a soft landing in the future. If we're wrong on the soft landing, and it tends to be a harder landing, why that financial forecast will be a little bit off, but we have built in increasing credit costs. And again, I'm speaking for the industry as a whole. increasing credit costs, and still looking for up 10% earnings per share next year, which I think is going to be a very good headline and a little bit of an attention grabber.
And Tom, maybe if we think about how do you translate that into stock performance, maybe for the industry, however you want to segment it, to large banks versus regionals, but also I think the audience would be interested in relative performance to the rest of the S&P.
There is a tremendous amount of bad news in bank stocks at the moment. And look, we just talked about it. It's negative operating leverage, negative earnings per share, concern about credit quality. I hope later we get a chance to talk a little bit about regulation in the election. So you could come up with many reasons to be cautious. I've been doing this for 38 years. My observation is that's all true, but how much of it's already in the stocks? I look at the stocks. I see some of the best banking institutions in America trading at 7 times earnings with dividend yields of 5% and higher. And I believe the industry is a coiled spring for good news and for good developments, because there's so much bad news in the stocks. It won't take much to get them to really, I think, start moving. If you look at the relative PE multiple to the market, bank stocks trade about half of the market multiple. Now, there's a numerator and a denominator to that ratio, so the stock market could be a little bit overvalued. But still, this gap is too big. And I think that over time, if we get any normalization in how the industry is valued, I think there's considerable upside in the group overall. You mentioned big versus small. Big has really been outperforming the smaller banks for a while now. And that's for a variety of reasons. One is scale is working. The bigger banks tend to be more profitable. The bigger banks tend to have less commercial real estate. And the bigger banks tend to have more leverage into investment banking revenue. And when you look at some of our stock selections right now, you'll see that we like investment banks because, for example, we were looking at Goldman. Goldman's one of our recommended stocks. We think investment banking revenues could be up 15 to 20% year over year as capital markets have been healing themselves. But yet we think the annual run rate in our model is probably only about 75% of what a normal investment banking fee pool would look like. So you're getting 15 to 20% growth in the business, and the entire business still has room to normalize on the upside. So some of the bigger banks that have exposure to capital markets, investment banking, capital raising, and M&A, we think that instead of having wind just sort of against them, the wind will be in their sails going forward, which will help in that operating leverage conversation that I had earlier. So we think the operating leverage opportunity for the bigger banks is going to come back faster than for the smaller banks. And it's why we've been recommending them more aggressively. And it's why we think that their recovery is going to happen a little bit faster.
Tom, you mentioned we have a presidential election coming up this fall. Obviously, we've got a debate tonight, which I won't ask you to comment on. But as you look out past the election and think about the different outcomes, what do you think that means for the industry as you look forward?
I think the big thing is that the fundamental dynamics of the industry are going to happen regardless of who's president. But I think the degree and the speed of what happens could be very different. As you know, we've been in a very aggressive regulatory environment, maybe is how I would explain. And you can see lots of new proposals coming out. There have been a lot of new demands on the banking industry. A lot of this, what it does is it increases costs into the industry. It increases uncertainty for the management teams. And also, too, consolidation has been such an important part for the last 30 years. And if you look carefully at the FDIC recent meeting notes, where some of the directors of the FDIC spoke about the fact that there's been like a doubling in the amount of time that merger applications have been taking to be approved, which has really been a big headwind for the industry to think about scale as a way to build a healthier industry down the road. You could see that it's been a tricky environment. And I think who's running the policy on a lot of these issues, I think is important. And also, too, I think we've reached a point in financial services with banks only being about half of financial services now. I think we've reached a point where there needs to be a broader discussion, not about what we don't want for financial services, but what does the nation want the financial services industry to look like? Because the decisions that are being made by policymakers and regulators now will determine what financial services will look like. And the industry segment that I've been talking about the most with regards to that is mortgage origination. You go back to before the global financial crisis, and what you'll see is that 7 of the top 10 mortgage originators in America were banks. Now, here we are more than a decade later. We've had a chance of all the regulatory proposals to come into the industry, and today only 3 are banks. So that activity has been pushed out of, because of regulation, out of the banking industry, and decisions that are being made by policymakers today could very likely have the same outcome. So that's why I think what the overall philosophy is of policymakers is really important to the industry and the economy at this moment.
Tom, maybe just on that same topic on regulation, maybe more specifically with Basel III Endgame, with the proposal and reproposal to come.
This is so critical because, the policy response to the bank failures last year was, hey, we're going to bring heavier regulation on capital down lower into the industry. Meanwhile, the banks that failed all met the capital rules and would probably meet the new capital rules. That wouldn't have stopped them from failing. What caused them to fail is a lack of depositor confidence because of other reasons. And what we need strengthened deposit insurance reform. And what we need is the market believes that too big to fail is true. And that is the most unstable part of the industry, in my part, during times of crisis. And what we need is small business to know that they can leave their money in a regional bank in a safe manner. And at the first sign of trouble, they don't need to go find a bank based on its size rather than its effectiveness. And that's why when I testified in front of Congress last year, I called for higher insurance limits for small business transaction accounts. Think of payroll accounts. And that's back in the moment from last year. That was really the pressure point, in my opinion. Now, the Fed chairman has said that there is going to be another look taken and that they were going to accept the Basel III comments from the industry and other industry observers, and that there are likely to be amendments. So we would think maybe by the end of the summer into the fall, we'll see what those are going to be. But what I can tell you is the implementation at $100 billion of the heavy capital requirements, for example, of TLAC, I think go opposite the tailoring policies that were in Dodd-Frank, the tailored approach to regulation, because if $100 billion banks are required to take 6% of risk-weighted assets and go out and issue a debt instrument, that debt instrument will be issued at a much higher cost than the global SIFIs. So that's going to favor the G-SIFIs in that type of lending business. Plus, that 6% TLAC charge is going to tip the balance towards the non-banks. And when you look at the mid-sized banks, they are the ones that really provide the most credit to small businesses. Remember, during COVID with the PPP program, 55% of PPP went not through the big banks, but through the community and regional banks. And I think that demonstrates who is serving the small businesses in America, where more than half the jobs are. So these are really important issues. And I would call on policymakers to really think about exactly what the response is to last year's turmoil with where we're going with policy. And I really believe that we will see some softening of the approaches, but I do still think that we're leaving the biggest opportunity to deposit insurance reform behind. That might have been a longer answer than you were looking for, Peter.
Yeah,
but nonetheless, I think it's interesting as we approach this next chapter.
Yeah, no doubt. Tom, you mentioned scale earlier as well and the need for scale. Let's talk a little bit about consolidation. Since we last spoke, there have been a number of deals announced. What do you see going out into 25 and what you're looking for to see that activity tick up?
Well, I think we are in the next merger wave. We don't have to worry about, is it starting? It has started. And I think it really started with the $35 billion merger that Capital One announced of Discover. And since that time, we've seen several other mid-sized banks in particular look to gain some scale. And what I find positive is that even in a challenging environment where the regulatory approval process has been, you have the uncertainty of that and the extension of it, particularly with FDIC approvals. What you see happening is that banks have still been willing to go down this path. So I think that's number one. Number two is the investor response has been much more favorable than it was a couple of years ago. And I think that's for a couple of reasons. One is that I think there's been a little bit more of a pricing that's been a little bit more favorable to the buyer, with the idea that there's going to be a combined earnings per share accretion that's going to drive the return for both the seller and the buyer. So I think deal design has been a little bit more favorable to the purchaser, and I think that investors have rewarded that. And then also, I think there's been a scale difference. We've generally been seeing banks not doing MOEs at this moment. You see more of a traditional sort of difference in the size between the two companies in the merger, and I think the market's been rewarding that. So I think that that's been important, that there's been a more positive market response to this consolidation. But again, if I showed you the data, what you can see is really size of bank has been a big determinant to profitability. And I think all the reasons, classic reasons for scale, are the reasons behind it.
Great. Tom, we've covered a lot of ground in a short period of time. The quarter outlook, the stock performance, covered the election, regulation, M&A. Maybe just your parting thoughts. How would you summarize all of that? What would you leave the audience with as your takeaways?
Well, we covered a lot, and like I said, I could go through the list again of things that we can think that create uncertainty. But I think the real bottom line here is if you and I were getting together at any moment and we said, let's design an environment that's challenging for the banking system, we would probably come up with inverted yield curve right after interest rates just went up a lot, which is exactly what just happened. So when you look at the financial results of the banking industry today, I actually think for all the headwind that the industry has, all the uncertainty that we've talked about, I think the industry's actually done a darn good job. And remember too, last year we had these three big bank failures, or not, they weren't big banks, they were mid-sized banks, but there was a concern about contagion. And then what's happened since? Well, aside from maybe a very small one or two that have happened, there's really been no contagion, and the industry's actually done pretty well. And these headwinds are about to abate some. And I also think now is a good moment to step back and say, hey, there's been a tremendous market share shift towards the non-banks. I really do think policymakers should take a step back and think about what the whole picture should look like in terms of policy, and how can the playing fields be level. And I would think it would be in policymakers' best interest to have more of the financial services industry inside some safety net or area of oversight. But nonetheless, I think we're at a moment where that should happen. But I think the banking industry's done actually, I think, very well, given the challenges that's been in front of it. And I think that's the big picture. And I do think that once some of these headwinds abate a little bit, I think we'll get recognition in the stock market. Remember, the Keefe Bank indices went up about 34% from the end of October to the end of last year, just when the market started to think about what a Fed pivot was going to mean. So these stocks can move quickly. And I think the industry's done a good job of remaining stable and getting ready for the next chapter.
Great. Tom, let's end on that positive note. Thank you so much again for sharing these timely insights with the audience. Really appreciate it. It's always great to be with you. I hope you have a great 4th of July holiday next week, and look forward to see you again in the third quarter.
Peter, same to you, and it was great to be with you.